Pleasure and honor of bringing on our visionary and founder of Note School, Mr. W. Eddie Speed. How are you, Eddie?
How are you?
There he is.
Well, as you may have guessed, I have been very busy this morning, right? Because Joe, you're part of the team that helped scrape data for me, and Bob Repass and some other guys helped me. And we have, well, Brian, we really do have a wild market, and it is about as dramatic as you made it sound.
And it's not just in Coeur d'Alene. Is that what you're saying?
Oh, my God.
Well, you fill us in.
All right. Are you guys ready?
I'm ready.
Are you ready for the 40,000-foot view of the market?
I see it, and I see Albert's ready. I see Chris is ready. We got a lot of people here attending who are ready for the update.
All right. In the bottom left corner of these slides, there's an email address, guys. And that email address is if you would like the slide deck that has these data slides, reach out to us, and we'd love to send them to you. Okay?
Yes.
All right. Joe, that's an iceberg.
That is an iceberg. And we have an Airbus A380 that was flying over that iceberg, right?
We have what's great, and we have what's not so great.
Yep.
All right. You get the analogy?
I get the analogy 100%.
All right. Let's talk about what's hot. What's on fire? Huh?
What's hot and what's not. Let's do it.
All right. Well, first of all, the stock market surges. It continues to surge, and it's breaking records, and whatever your affiliation is to the stock market, if you have anybody feeding you information, Joe, if you don't buy stock now, you'll never be able to afford it. You know what I'm saying?
Nod, right? You got to nod when you're doing
that. All right. Well, a lot of people in our business are not just focused on stocks, but they're focused on alternative investments. Let's talk about the number one alternative investment, and that is the housing market. Okay. This isn't commercial real estate. We're going to stay focused on housing for a little bit because it is on fire. Commercial has some interesting elements in the market, and there's some things that are really good and not, and it's just a big story, and we'll, have to continue that at another point. First of all, inventory is down 40%, guys, and that made annual prices grow to just under 12%, okay? And that was in January. Well, it's even gotten bigger, right? Bigger story. So we're going to look at some of the breakdown in the market, some of the details, as Joe mentioned. Joe, Coeur d'Alene, Idaho, which I have been there, and
beautiful.
I have a number of friends there. In fact, the largest real estate investor in Coeur d'Alene, Idaho, is a friend of mine.
Oh, wow. Didn't know that.
That's a fact. And but that's a hot market. And the truth of the matter is that also in that market, though, it is not a top 30 market. So sometimes it's not listed. Austin would be a top 30 market.
Correct.
Here's some amazing stats, guys. This is hot off the press, as in it came in yesterday afternoon from Redfin. Okay. So these are pending sales under contract within 1 week. So fellas, what this is telling you is that set properties that are under contract 1 week after being listed, 46%. Say it ain't so, Joe.
Absolutely.
How about that? Here's another stat. 45% of the houses are selling above list. Okay. And 45% sold. And that is up 18% from a year ago. So that's a pretty significant number. Almost double.
Eddie, my brother-in-law lives there in Highland Park in Dallas. Put his condo up for sale last Saturday. Sold it before noon, 20,000 over list in 2 hours.
It's just the norm.
It's just the norm.
All right, here is the sale to list ratio, Joe. The sale to list ratio, and it is now climbed over 100%. So what does that mean exactly? That means that over 100% of every property listed is selling for over its list price. Correct. It has broke 100%. Yep. Now, fellas, I don't know what you call a wild market, and I don't know how dramatic you can act, Brian. But this is pretty dramatic. Yeah. Here's another thing. This is from Lending Tree, and they listed, Joe, the top 10 markets, and there's a little chart there that shows you. And obviously, as you can see, these markets are really hot, and then you're seeing a little pattern here, and you're seeing a little pattern here. All right, the hottest 10. They're all hot, Joe. Everything's on fire. Yeah. In fact, to show you this, what we did is we gathered some data, and this was a change from January to February. You remember this data comes out late, Joe. So this is, and there's a couple of interesting things here. There's some markets that are increased in a month, Joe, over 2%. Right? And this is the change, Joe, from a year ago. And there are some markets that have increased there.
Guys in Phoenix, man.
Yeah, I've done a lot of training in Phoenix here in the past few months, and I'm doing an event where I'm probably speaking to the top 100 house buyers in Phoenix in about 2 weeks. And let me just tell you something. They're pretty clear about one thing. If they don't add creative financing to their business, just trying to buy something at a low price is probably not the most effective technique out there.
Absolutely.
Yeah. And nationwide, Joe, this is everywhere. And this is an index that they do, this index level, and take a little more to explain all that is, but it's just sort of a confidence level.
Right.
An average of 1.1% change from January to February, and an average from a year ago of a 12% increase. That is nationwide in housing. Now, what is driving this? Well, they say the number one factor is FOMO. What does that mean? Well, it means fear of missing out. There you go. That's actually not such good information to me, Joe, because I would rather a market be driven by other variables, but they say this is it. So I made you this little slide, Joe.
Okay.
It's all about FOMO. Fear of missing out. All right. So this is a big factor, and there's a lot of good stuff happening to residential real estate. We do not want to exclude that. We don't want to make that. That's not like that's not part of the equation. It is a huge part of the equation. Now we're going to talk about things that aren't so good, Joe, and we're going to talk about opportunities. Right?
Broken glass.
We're going to talk about how to find the broken glass and how to be the problem solver. First of all, lumber prices. Joe, I will tell you this, that in the active real estate investing that I'm involved in right now, I'm concerned about doing anything that has a heavy rehab in it. Okay. Lumber prices have tripled. And, it's the old story of a 2x4 used to cost $4 last February. And now that 2x4 kind of costs more like about $12.
That's right.
Right. And it's not just lumber, but lumber is a big deal. And if anybody's been in there involved in it, there's a case. So there's some deals that would not be a deal for me to do real estate investing right now, Joe. I'm not just concerned about what the price I have to pay for the materials, but I'm concerned about accessibility of the materials.
Right.
Right. There's a lot of materials, this that we're seeing the car industry complain about this. So accessibility is a big deal. They got all these ships and harbors and Suez Canal, that were in the Suez Canal and stuff. Now they've found their way out of the Suez Canal, Joe, and now they're just stuck in the harbor. They can't unload them, and it's a problem.
It's a lot. Yeah, that's right.
That's it. So the big thing that we talk about a lot, of course, is the significant amount of difference in who could get credit. Call it about a high in here, Joe, and we're trending up a little bit. It is not projected that the underwriting is going to change that much. But Joe, if you took the high before the virus and now, we're still, just call it north of a 30% decline in who can get a mortgage.
That's a huge gap.
1,000 people that could get a mortgage in, February in 2020 and March in 2021, 300 of those people don't get a mortgage anymore. Here's my question, Joe. Opportunity or bad?
Certainly an opportunity for us. And, Eddie, going back to the lumber slide, not only that, it's the labor force in order to do the rehab, right?
No doubt about it. So, by the way, Wall Street Journal, Joe, it's got to be true when the Wall Street Journal finally writes about it. And so they did write about this and the credit crunch and need a mortgage. Good luck. And so it's real now, Joe, because the Wall Street Journal says it.
He said it was. Yeah.
Ellie Mae says that the average down payment is about 19%. So the average loan to value of a conventional loan is about 81. So just take the difference off. And then Lending Tree said, well, the average in the top 12 metro areas is 19%. The average is 21% down in metro areas and an average overall of about 19. So this is about 20% down. Just call it about 20% down is what people are paying down. By the way, Joe, let me just tell you a little secret. What they're not measuring in that is what people are paying at over list.
Exactly.
Right. They're taking list price and they're paying 20% down of list price. But if they're paying over list, that's also in the down payment numbers.
That's right.
So what we see is this: seller financing when the market is really good and lending is easy. Seller financing is, let's just call it, Joe, a sliver of the market. It is not a major contributor in the market. So when the market is really loose and mortgage financing is easy, then seller financing is really no big deal. The virus comes along and all of a sudden we see scarce lending. And all of a sudden, Joe, we see what we call a gap. Right. And that gap is a market that could be filled with my puzzle piece of the guy seller financing. Got a lot to say about this. This is a huge factor in the note business. The biggest we've seen in a long time.
Yes.
Because you can finance such good people. Okay, M Report says house flipping is down. Yes. House flipping profits are down. Well, that's obvious, Joe, right? Isn't that obvious that house flipping profits are down because people are demanding a crazy price?
Right.
Why am I going to Phoenix? Why do these guys show up at Note School all the time? Because they're trying to learn creative financing along with buy low, sell high for cash. So they're adding two pieces to their business. This is probably the biggest opportunity that real estate investors are seeing today, is to not just stick with the buy low for cash price, but also add the creative terms. And that's a big deal in what we make it part of. So this is an opportunity for the real estate investor that can look beyond being a one-trick pony.
Correct.
Right? Let's talk about the landlords for a minute. I'm going to blow through these really fast. 72% of every 1 to 4 family, 72% is all owned by somebody that's a small-time landlord. They own 1 to 5 units in their individual name. Okay? So the other corporately owned properties, they're just not a major significant force. I read, articles and corporate America's buying houses and stuff, and I eliminated a lot of noise today just because it was too much to present. But the truth of the matter is they're still just a sliver of the market.
Right.
Right. And a lot of these small-time landlords self-manage. Now, Joe, what does self-management look like?
That's probably being kind there. It's probably a little more harried than that.
That is the opportunity. Small-time landlords are getting killed. I did do this slide the last time, but I want to just renew it because it's so important. 10.25 million renters owe $53 billion in rent. Small-time owners manage 77%. Now, they call small-time owners, this is people that own 1 to 10 houses, not 1 to 5 as the ratio I gave you a while ago, right? The smaller the number of houses they own, the more likely they are to self-manage.
Yeah.
That's an interesting fact.
Yeah.
So the Urban Institute says that they owe an average of $6,000 in rent, and that housing providers can't cover the shortfall. This is your distressed seller, the hobbyist landlord. This is it. This is the guy that we would teach you to go chase.
Yep.
Right? Lenders, listen, guys, there's an issue here. We're talking literally. If you're looking at these stats here, loan servicers are still writing these monster checks on a monthly basis. $3.3 billion in principal and interest payment. Add on to that, if they're collecting escrows, they have another 1.2. This is $4.5 billion a month they're writing. Call that $1 billion a week.
Yeah.
How much longer can this continue at $1 billion a week? Can loan servicers continue to survive and do this?
That's right.
Right? The other side is delinquency. Delinquency is a giant deal. In fact, in the top 30 metro areas, the delinquency is crazy high. Average on all FHA loans, Joe, average nationwide is just a tick under 15%.
Yeah.
Well, Joe, I have a little experience in that side of the business. I'm glad you asked.
Yes, we do.
So non-performing notes, they are becoming a thing, a big thing. And we are having a lot of people come to note school trying to learn about that side of the business. And bottom line is, Joe, if I take loans that are 30 days or more delinquent, we are just under 3.5 million loans. That represents 6% of the market, Joe. 6% of every mortgaged house is delinquent, and then another 3% is in forbearance.
That's a pile.
So let's talk about this. Stock market surges. Awesome, right?
Yep.
Raging resi real estate market. Anybody argue that statement? Right? Low interest rates. So we have very low interest rates, which is definitely driving the affordability of the market. It has to be affordable, Joe, right?
That's
Prices
it.
are going up. The rates are what keep the payment still affordable.
That's right.
If that changed, it could affect things.
Just a little bit.
FHA loans, 14% not paying. Overall, 9% of residential mortgages not paying, either in forbearance or in default. Default loans that are in default outpace loans in forbearance 2-to-1.
Right.
10 million renters owe $54 billion in back rent. 35% decline in mortgage credit availability. And the commercial real estate market, Joe, is in a lot of these non-performing loans, we are hearing it on a weekly basis. There are portfolios, tapes, they call them. That's just a spreadsheet of these non-performing notes secured by commercial properties are now coming to the marketplace. Right? Let me ask you guys a question. Opportunity or not an opportunity? Is the market bull or bear or both? Depends on which lens you're looking through, right?
That's exactly right.
All right, so let's just talk about this. By the way, remember I told you guys, if you have an interest at all, then you can go to info@noteschool.com and you guys can go get, see if my little laser pointer here will show you this. You guys go right there and we will be glad to provide you the slides. I call this presentation today, The Market Beyond the Mask. You like that, Joe?
That's very clever, Eddie. That must have came to you in a dream. Yeah. Seriously, it's good.
Yeah. All right. So I don't have a crystal ball, but I do have a rear view mirror. How about that? And I've lived through some rear view mirrors and black swan events. Now you may look at this market and say there's nothing black swan, but I look at this market and say there are some black swan elements to this market. And I see this as a runway of a terrific opportunity for us, Joe, not for the next 6 months, literally for the next 5 years.
That's right.
Right. And so we have a lot to say about this, and not just that it's good in some areas and bad in some areas, but how we find the crease, how we find the dent in the market. That dent is our opportunity.
Right. That's it.
Joe, I'm out of soap.
Eddie, that was bigger than a wagon wheel, right? And a wagon wheel is pretty big, as your dad used to say, right?
That's it. That's it.